mentioned, one of the uses of productivity, a company can turn around and cut prices. One of the other anti-inflationary forces out there is the dollar. Now, if you take out what happened in the early 80s, which was actually a very deflationary period, especially for emerging markets, you can see that we're heading up towards the high end of where the dollar has been over the last 40 to 50 years. So this is a powerful anti-inflationary force, and it is another reason that we expect inflation to continue to unwind during the next year to 2 years. Now, on this next chart, you can see money growth in the purple was negative for quite a long period of time. It moved into positive territory last year. We're still at a very low level by historical standards, roughly 3.5%. You can see inflation in the green line. It broadly, there is a correlation with money growth. Now, the big controversy right now is, are we stuck at this 2.5–3% range? We do not believe that we are stuck there, and that the big surprise will be much lower than expected inflation, thanks to productivity gains, thanks to the dollar going up, and thanks to monetary policy that has been quite restrictive. And I think Chairman Powell still describes monetary policy as restrictive. So inflation typically follows money with a lag. And we do think that we will see more gains against inflation. And we're still saying we would not be surprised to see some negative numbers out there. How could we get those if money growth is turning around like this? Well, we would get that if the velocity of money slows down. And it has been slowing down. And I think the uncertainty associated with the transition to a new administration could be one reason for velocity to slow down, taking any expansionary power away from this money supply growth. So stay tuned on that one. The yield curve has been very interesting. We've featured it ever since we started these in the know videos, because it went negative and stayed negative for a very long time. You can see here in this chart well, first let me explain what the yield curve is for those who don't know, who haven't been tuning in. It's the difference between the 10-year Treasury yield and the 2-year Treasury yield. And typically, longer-term interest rates are higher than short-term interest rates. And when they are not, when the yield curve inverts, it's usually a period of very tight monetary policy that leads to a recession. So if you look at the shaded areas on this chart, these are the recessions, and you can see that they are associated with inverted yield curves. The yield curve inverts, and then we go into a recession.